In our world today, the environment teeters on a delicate balance. How can economic tools like Pigouvian taxes and emissions trading systems help? Earth's environment is a complex and fragile system, with biodiversity, climate stability, and many other factors all interweaving in a delicate dance. We're witnessing a growing need to address environmental issues, and the time to act is now. But how can we do this effectively? Enter the world of economic tools. Specifically, we're going to take a closer look at Pigouvian taxes and emissions trading systems. These tools are designed to address environmental concerns in a way that integrates with our existing economic systems. They are not just theoretical constructs, but practical mechanisms that have been implemented in various forms around the world. These tools aim to help us navigate the difficult and often complex decisions we need to make to protect our environment. To understand their impact, we first need to delve into what these tools are and how they function. Pigouvian taxes, named after economist Arthur Pigou, are designed to correct market inefficiencies. So what does this mean exactly? Let's dive in. In a nutshell, Pigouvian taxes are a type of tax levied on any market activity that generates negative externalities, or in simpler terms, costs that are not paid for by the person or entity responsible. These taxes are intended to correct what's known as market failure, where the market on its own doesn't allocate resources efficiently. To put this into perspective, let's take pollution as an example. When a factory emits harmful pollutants into the environment, it's creating a negative externality. The costs associated with this pollution, such as health problems and environmental damage, are borne by society, not the factory. In an ideal world, the factory would take these costs into account and reduce its pollution. But in reality, this often doesn't happen. This is where Pigouvian taxes come into play. These taxes are set at a level equal to the cost of the negative externality. In our example, the factory would be taxed for the pollution it produces. The idea is that this tax will incentivize the factory to reduce its pollution to avoid the tax. Now, how does this relate to environmental issues? Well, Pigouvian taxes can be used as a tool to address environmental problems. By taxing activities that harm the environment, we can encourage companies to find cleaner, more sustainable ways of doing business. While Pigouvian taxes offer a straightforward approach, their effectiveness can be influenced by a number of factors. For instance, accurately calculating the cost of a negative externality is often challenging. Also, these taxes can sometimes be regressive, impacting lower-income individuals more heavily. In essence, Pigouvian taxes are a powerful tool in the arsenal of environmental economics. They offer a way to make the polluter pays principle a reality, helping to steer us towards a more sustainable future. In contrast to Pigouvian taxes, emissions trading systems offer a more flexible approach to environmental regulation. To understand emissions trading systems, imagine a game of musical chairs where the music is carbon emissions, and the chairs are the rights to emit. But unlike musical chairs, the objective of this game is not to hoard chairs, but to reduce the number of chairs over time. Simply put, an emissions trading system, or cap-and-trade system, is a market-based approach to controlling pollution. It places a hard cap on the total amount of pollution allowed in a given period. This cap is then divided into permits, which are distributed to firms. Each permit allows a firm to emit a certain amount of pollution. Firms that reduce their emissions can sell their unused permits to firms that need to emit more. Over time, the cap is gradually reduced, forcing firms to innovate and find ways to pollute less. So, what's the purpose of this system? Well, it's all about providing an economic incentive for companies to reduce their carbon emissions. If a company can find a way to emit less, they can sell their excess permits and make a profit. Conversely, companies that can't reduce their emissions as easily have to buy more permits, which hits their bottom line. The beauty of emissions trading systems is that they harness the power of the market to achieve environmental goals. They don't dictate how companies should reduce emissions. They simply provide an economic incentive to do so. This leaves room for innovation and allows companies to find the most cost-effective ways to cut their emissions. But it's not all sunshine and rainbows. Like any system, emissions trading has its challenges. For one, setting the right cap is tricky. Set it too high and it won't encourage enough emissions reductions. Set it too low and it could hurt the economy. Monitoring and enforcing compliance is also a major challenge, not to mention the risk of market manipulation and fraud. Though emissions trading systems provide flexibility, they too have their own set of challenges. Both Pigouvian taxes and emissions trading systems are examples of internalization mechanisms, but they face what is known as the boundary problem. Now let's dive deeper into this. Internalization mechanisms are tools used by policymakers to ensure that the costs of negative externalities, such as pollution, are borne by those who cause them. This is done in an attempt to reduce these harmful effects. Underlying this concept is the principle of the polluter pays. Pigouvian taxes and emissions trading systems are two such mechanisms where this principle is applied. Pigouvian taxes, named after the economist Arthur Pigou, are levied on any market activity that generates negative externalities. The goal is to correct the market outcome to account for these externalities. For instance, a tax on carbon emissions encourages firms to reduce their carbon footprint, internalizing the environmental costs. On the other hand, emissions trading systems, also known as cap-and-trade systems, set a maximum limit on emissions and allow firms to trade emission permits. This creates a market for pollution rights and gives firms a financial incentive to reduce emissions. However, these mechanisms face the boundary problem. This refers to the difficulty in defining the boundaries of regulation. It's tricky to determine who should be taxed or how much emissions should be capped. There's also the challenge of monitoring and enforcement. Without clear boundaries and effective enforcement, these mechanisms can lose their effectiveness. For instance, if a firm can easily evade a Pigouvian tax or if the cap in a cap-and-trade system is set too high, the intended environmental benefits may not be realized. Furthermore, the global nature of environmental issues adds another layer of complexity to the boundary problem. How do we ensure fairness and effectiveness in a global market with diverse economic and environmental contexts? Despite these challenges, internalization mechanisms have the potential to play a significant role in environmental regulation. They offer a way to align economic incentives with environmental goals, making it financially beneficial for firms to reduce pollution. This, in turn, can drive innovation and sustainable practices, playing a pivotal role in the fight against environmental degradation. The rise of environmental, social, and governance (ESG) factors in investment decisions has brought renewed attention to economic tools like Pigouvian taxes and emissions trading systems. Let's take a moment to unpack this. ESG is a framework that investors use to evaluate companies on their environmental, social, and governance performance, alongside traditional financial metrics. This holistic approach has gained momentum in recent years, as investors increasingly recognize the financial relevance of ESG risks and opportunities. So, where do Pigouvian taxes and emissions trading systems come into play? These market-based mechanisms can support ESG objectives by incentivizing companies to reduce their environmental impact. They do this by essentially putting a price on pollution. Pigouvian taxes, named after the economist Arthur Pigou, are levied on companies that generate negative externalities or costs that are borne by society rather than the company itself. By forcing companies to bear the full cost of their actions, these taxes encourage more sustainable behavior. On the other hand, emissions trading systems, also known as cap-and-trade systems, set an upper limit on emissions and allow companies to buy and sell emission allowances. This creates a market for pollution rights and incentivizes companies to reduce their emissions in the most cost-effective way. Both of these mechanisms can support ESG objectives by encouraging companies to minimize their environmental footprint. For example, a company that reduces its emissions below the cap can sell its excess allowances, providing a financial incentive for sustainable behavior. Meanwhile, a Pigouvian tax can make it financially unattractive for a company to engage in environmentally harmful activities. In this way, Pigouvian taxes and emissions trading systems offer a powerful way to align economic incentives with environmental goals. They provide a clear signal to the market that pollution has a cost, and that companies are expected to bear that cost. As we navigate the complexities of environmental challenges, these tools continue to evolve and play a pivotal role in our path towards a sustainable future. In a world where the environment and economy are intertwined, understanding Pigouvian taxes and emissions trading systems becomes crucial. We've peeled back the layers of Pigouvian taxes, a tool designed to correct market failures by taxing harmful externalities. We've also explored emissions trading systems, a market-based approach that sets a cap on emissions and allows companies to trade their emission allowances. We've delved into the concept of internalization mechanisms, strategies that aim to incorporate the cost of negative externalities into the price of goods and services. We've discussed the boundary problem with regulation, a challenge that arises when trying to regulate pollutants that don't respect geopolitical boundaries. Lastly, we've examined the rise of ESG, environmental, social, and governance criteria, and its relation to these economic tools. All these components interact, shaping the way we address environmental issues in our economy. As we continue to adapt and innovate, these economic tools will undoubtedly shape our approach to environmental sustainability.